Hey everyone, welcome back to the podcast. I'm Mark.
And I'm Chad. What's up, folks? Today we're going all in on one of the most talked about but least understood goals in personal finance: financial freedom.
And we mean really all in. We're combining two powerful frameworks today: a 10-step roadmap to achieve financial freedom and the 12 daily habits that make it stick for the long haul.
Because here's the thing, knowing the steps is one thing, but if you don't have the right habits, those steps don't go anywhere. It's like having a map, but no fuel in the car.
Exactly. So today you're getting both, the strategy and the behavior. And by the end of this, you'll have a complete picture of what financial freedom actually looks like in practice.
Let's kick things off with the roadmap, 10 steps to financial freedom. Then we'll layer in the daily habits that support each one. It's going to be a meaty episode, but stick with us because this stuff genuinely changes lives.
Step 1 is getting a brutally honest picture of where you stand financially right now. Income, expenses, debts, assets, all of it laid out in front of you.
This sounds basic, but most people skip it because they're scared of what they might find. I was like that. I avoided looking at my credit card balances for months because I didn't want to face the number.
That avoidance is so common. But here's the thing. You can't fix what you don't acknowledge. When you finally write it all down, something shifts. It's like shining a light in a dark room.
I had that moment when I finally tracked every expense for a month. I found out I was spending way more on food delivery than I realized. That one discovery changed my entire approach.
And the habit that supports this step is daily expense tracking. Not a big monthly audit, just a quick daily check-in. Log what you spent. Over time, it becomes automatic, and the awareness it builds is genuinely powerful.
Apps like Mint or YNAB make it easy. Or if you're old school, even a Notes app works. The medium doesn't matter. The consistency does.
Step 2 is creating a budget based on everything you just uncovered. And I know, budgeting gets a terrible reputation. People think it means saying no to everything fun.
But a budget isn't a cage. It's a permission slip. It's you deciding in advance where your money goes instead of wondering where it went.
The 50-30-20 framework is a solid starting point. 50% of income to needs, 30% to wants, 20% to savings and debt paydown. Simple, flexible, effective.
And the habit that pairs with budgeting is mindful spending. Before any non-essential purchase, pause for 24 hours. Ask yourself, does this move me toward my goals, or is this just a dopamine hit?
Studies show that pause alone reduces impulse purchases by nearly half. Your brain goes from emotional reaction to deliberate thinking. Over time, you literally rewire how you make decisions around money.
I started doing this a few years ago, and honestly, a lot of things I thought I wanted, I didn't actually want after 24 hours. The craving just passed.
Step 3 is tackling debt. This is one of the biggest roadblocks to financial freedom, and it's where a lot of people get stuck emotionally.
Debt can feel like a mountain you can never climb. I know because I've been there. I had credit card debt that felt suffocating. The key for me was choosing the snowball method, paying off the smallest balances first to get quick wins and build momentum.
There's also the avalanche method, paying highest interest rate debts first to minimize total interest paid. Both work. The best one is whichever keeps you motivated enough to actually stick with it.
The psychological wins of the snowball method kept me going. Every time I zeroed out a balance, I felt like I could actually do this. That motivation carried me through the bigger debts.
And the daily habit here is living below your means. Every time your income goes up, resist the automatic urge to upgrade your lifestyle. The gap between what you earn and what you spend is where financial freedom is built.
Lifestyle inflation is the silent wealth killer. You get a raise, you buy a nicer car. Get another raise, move to a bigger apartment. Suddenly you're earning more, but somehow still broke.
Step 4 is setting clear financial goals. What does freedom actually mean to you? Retiring at 50? Owning a home outright? Working for passion instead of necessity?
Goals give your money direction. Without them, you're just managing money with no destination in mind. And the more specific the goal, the better. Not I want to save money, but I want $20,000 saved in 12 months for a down payment.
SMART goals. Specific, measurable, achievable, relevant, time-bound, and break them into milestones. Celebrate hitting 25%, 50%, 75%. Those moments of recognition keep motivation alive.
The habit that supports goal setting is regular financial reviews, weekly or monthly check-ins, where you look at whether you're on track, what needs adjusting, and what wins you can celebrate.
Reviews are where the strategy meets reality. Without them, goals drift. With them, you catch problems early and stay intentional.
I do monthly reviews, and honestly, it's become something I look forward to. It's like checking the score during a game you care about.
Step 5 is building your emergency fund, typically 3 to 6 months of essential living expenses in a liquid, accessible account.
The emergency fund is your defense. Without it, every unexpected expense becomes a debt trap. Car repair, medical bill, job loss. Without savings, these force you onto credit cards and set your progress back months or years.
If you're just starting, even $500 or $1,000 makes a difference. Start small and build from there. The key is having something before life throws a curveball, because it will.
And keep it separate from your checking account. Out of sight, out of mind. You want it accessible but not so easy to dip into that you treat it as spending money.
The habit here is saving consistently, not just when you have extra, every single paycheck, automatically. Pay yourself first, before anything else gets a chance to claim that money.
Automation is the key. Set up automatic transfers to your savings account on payday. You never see the money in your checking account, so you never miss it. It's the single most effective savings habit I know.
Step 6 is boosting your income. This is sometimes the missing piece that people overlook while obsessively cutting expenses.
You can't budget your way to wealth if your income is too low. At some point, you have to grow what's coming in. That might mean negotiating a raise, switching to a higher paying role, developing a valuable skill, or building a side income stream.
The gig economy has opened up incredible options. Freelancing, consulting, creating content, teaching skills online. The barrier to earning more is lower than it's ever been.
But be intentional. More income streams can mean more complexity and burnout. Quality over quantity. Find something sustainable that aligns with your skills and available time.
And here's the trap to avoid. When income goes up, lifestyle has to stay put. Every extra dollar of income is either building wealth or funding a fancier lifestyle. Choose intentionally.
The habit that supports income growth is financial education. Constantly learning about money through books, podcasts, courses keeps you sharp, helps you avoid costly mistakes, and opens your eyes to opportunities you might otherwise miss.
I recommend one personal finance book per quarter. That's 4 books a year. Over 5 years, that's 20 books on wealth building. That's a serious financial education, and it compounds just like money does.
And be discerning about sources. There's a lot of noise and bad advice out there. Stick with established, evidence-based voices in personal finance.
Step 7 is investing, putting your money to work so it grows independent of your effort.
This is the step that separates people who build wealth from people who just manage to survive financially. Investing is how you escape trading time for money forever.
And the good news is, you don't need to be rich to start. Low-cost index funds, ETFs, and retirement accounts like 401ks and Roth IRAs are accessible to almost anyone. Even $50 a month invested consistently makes a real difference over decades.
Albert Einstein supposedly called compound interest the 8th wonder of the world. And honestly, when you see the numbers, it's hard to disagree. Time is your biggest asset when it comes to investing. The earlier you start, the less you need to contribute.
The habit here is investing regularly, dollar cost averaging, a fixed amount every month, regardless of market conditions. This strategy removes the emotion from investing and smooths out volatility over time.
Don't try to time the market. It's tempting but nearly impossible even for professionals. Consistency beats cleverness in investing almost every time.
Step 8 is automating your finances. Bills, savings transfers, investment contributions, all of it running on autopilot.
Automation is the ultimate financial habit because it removes decision fatigue. You can't forget to save if the transfer happens automatically. You can't miss an investment contribution if it's scheduled.
Set it up once, then just monitor periodically. You stay in control without having to actively manage every transaction.
And the habit that goes with automation is practicing gratitude. This sounds soft, but it's incredibly powerful financially. When you regularly appreciate what you have, you spend less chasing what you don't need.
I keep a gratitude journal, and I regularly write about financial wins, even small ones. Paid off a credit card, reached a savings milestone, stayed on budget this month. Acknowledging those wins builds the abundance mindset that makes all the other habits sustainable.
And when you operate from abundance rather than scarcity, your financial decisions become clearer and calmer. You're not spending from anxiety or boredom. You're spending with intention.
Step 9 is ongoing financial education. The landscape is always evolving. Tax laws change, new investment vehicles emerge, economic conditions shift. Staying informed helps you adapt.
And it builds confidence. When you understand how money works, compound interest, tax-advantaged accounts, diversification, you make better decisions and you're less vulnerable to scams or bad advice.
Dedicate time every week to learning. One article, one podcast episode, one chapter of a book. Small, consistent doses of financial education add up to real expertise over time.
The habit that pairs with education is giving back. This one surprises people, but it's genuinely transformative. When you start giving money, time, skills, your mindset shifts from scarcity to abundance.
Giving forces you to see money as a tool rather than a scorecard. It connects your finances to something bigger than yourself. And financially, it cultivates the kind of mindset that attracts and preserves wealth rather than hoarding or fear spending it.
I started giving a small amount to causes I care about a few years ago, and it completely changed how I thought about money. I stopped being afraid of it. I started feeling grateful for it. And counterintuitively, that's when my financial situation started improving most quickly.
Step 10 is regularly reviewing and adjusting your financial plan. Life changes. Income, family, goals, markets. Your plan needs to evolve with it.
Quarterly check-ins, at minimum. Annual deep dives where you revisit your goals, rebalance your investments, and assess whether your overall strategy still fits your life.
And during those reviews, don't just look at numbers. Reflect on your mindset. How are you feeling about money? Are you stressed, anxious, hopeful? Your emotional relationship with money shapes every financial decision you make.
Money is as much psychology as it is math. The most financially successful people I know aren't necessarily the smartest. They're the most self-aware. They know their triggers, their patterns, their blind spots.
Before we recap, I want to make sure we talk about something that doesn't get enough airtime. The common mistakes people make on the road to financial freedom. Because knowing what to do is only half the battle. Knowing what not to do is just as important.
Oh, this is such a good addition. And I'll be honest, I've made almost every single one of these mistakes myself at some point. So this isn't theoretical. This is hard-won experience.
Mistake number 1, waiting for the perfect moment to start. How many people say I'll start saving when I get my next raise, or I'll start investing when I have more money? That moment never comes. The perfect time to start was yesterday. The second best time is right now.
I delayed starting my retirement contributions for 3 years, waiting until I felt more stable. Do you know how much that cost me in compound growth? I don't even want to calculate it. It's genuinely painful to think about. Start with whatever you have, even $20 a month. Just start.
Mistake number 2, treating your emergency fund like a vacation fund. Your emergency fund is for emergencies. A sale on flights to Bali is not an emergency. A sudden car repair is. A weekend concert is not. A medical bill is.
I've seen people drain their emergency funds multiple times for things that didn't qualify as emergencies. And then, when an actual emergency hit, boom, straight back into credit card debt. The emergency fund has to be sacred. Mentally, put a lock on it.
Mistake number 3, investing without understanding what you're investing in. The crypto boom of a few years ago is a perfect example. People were throwing money into coins they'd never heard of because a friend said it would 100x. That's not investing. That's gambling.
I'm not saying crypto is bad. I've had some crypto exposure myself. But I knew exactly why I was holding it and how much I was willing to lose. Rule of thumb, if you can't explain in one sentence what something is and why you're investing in it, don't invest in it yet. Do the homework first.
Mistake number 4. Ignoring taxes. This one quietly destroys so much potential wealth. People celebrate investment gains without accounting for capital gains tax. Business owners don't set aside self-employment tax. People miss out on tax-advantaged accounts, like Roth IRAs or HSAs, that could save them thousands every year.
Taxes are one of the biggest wealth leaks and one of the most controllable. A good tax strategy isn't about cheating the system, it's about legally using every tool available to you. And if you're not working with a tax professional at some point in your wealth-building journey, you're almost certainly leaving money on the table.
Mistake number 5. Comparing your financial journey to someone else's. Social media makes this incredibly dangerous. You see someone your age posting about their investment portfolio or their vacation home and you feel behind, but you have no idea what their actual situation is, whether they're in debt, whether they got an inheritance, whether that's all financed.
This is such a real trap. Someone once told me, don't compare your chapter 1 to someone else's chapter 10. You don't know their full story. Run your own race. Your financial freedom is defined by your values, your goals, your timeline, not Instagram.
Mistake number 6, and this might be the most dangerous one. Giving up after a setback. You missed your savings goal 1 month. You impulse bought something you regret. You made a bad investment. It happens to everyone. The difference between people who achieve financial freedom and those who don't isn't that one group never fails. It's that one group gets back up every single time.
Financial resilience is a skill, the ability to take a hit, regroup, and keep moving. I've had months where I completely fell off the wagon financially, spent way over budget, skipped my investment contribution. And the temptation is to say, well, this month is already ruined, might as well keep spending. That's what people call the what the hell effect. Don't fall for it. One bad month doesn't define your financial future. Your response to that bad month does.
So to summarize the mistakes, don't wait to start, protect your emergency fund, invest in things you understand, get smart about taxes, run your own race, and never let a setback become a quit.
6 mistakes, 6 warnings, and the beautiful thing is every single one of those is correctable. No matter where you are right now, you can course correct. That's the message I want people to walk away with.
Let's do a full recap because we covered a lot today. The 10 steps to financial freedom. 1. Get an honest financial picture. 2. Create a budget. 3. Tackle your debt. 4. Set clear goals. 5. Build your emergency fund. 6. Boost your income. 7. Invest consistently. 8. Automate your finances. 9. Commit to ongoing education. 10. Review and adjust regularly.
And the 12 daily habits that make those steps stick. Budgeting, daily expense tracking, mindful spending, consistent saving, strategic debt management, regular investing, financial education, living below your means, setting specific goals, regular financial reviews, practicing gratitude, and giving back.
2 frameworks that work together perfectly. The steps give you the what and when. The habits give you the how and why.
And here's the thing. You don't have to be perfect at all of these immediately. Pick one step and one habit to focus on this week. Build from there. Consistency over time beats intensity in the short term every single time.
Progress over perfection. That's the mantra.
Financial freedom isn't a destination you arrive at. It's a way of living. Intentional, informed, and purposeful with your money every single day.
Before we go, here's our question for you. Which of today's 10 steps or 12 habits are you going to start with this week? And why? Drop your answer in the comments. We genuinely read every single one, and your answers help everyone else in this community too.
Thanks so much for spending this time with us. This was a big episode, but an important one. Go build that freedom.
Take care, everyone, and we'll see you next time.
Later!